Have you ever wondered how investors make money when stock prices fall? Well, it's not magic, it's a strategy called short selling. Picture this: an investor spots a stock they believe is overpriced. They borrow these stocks from a broker and sell them straight away on the market. Now, they're waiting, hoping the price will drop. If all goes to plan, the price falls, and they buy the same number of stocks back at a lower price. They return the borrowed stocks to the broker and pocket the difference. It's like selling high, buying low, but in reverse order. It's a gamble, a high-stakes game of predicting the future. They're not investing in a company's success, but rather they're betting on its failure. This might sound a bit counterintuitive, but that's the fascinating world of investing for you. So in short, they're betting against the success of a company. Now, you might be thinking, wow, that sounds like easy money. But hold your horses, it's not that simple. Short selling, while potentially profitable, is a risky venture. It's like a double-edged sword, with the blade of benefits on one side and the sharp edge of risks on the other. Let's start with the bright side. Short selling allows you to profit from a declining market or a poorly performing stock. You can make money when others are losing it. Quite the contrarian, aren't you? But here's the catch. The risks are just as high as the rewards. Imagine this. You borrow a stock, sell it, and then the price skyrockets. You now have to buy back the stock at a much higher price than you sold it for, resulting in a loss. And the worst part? Your potential losses are unlimited because a stock's price can rise indefinitely. Remember, high reward always comes with high risk. So, now that you've got a grasp on short selling, what about this other term you've probably heard tossed around? Leverage. Think of leverage as a tool, a means to amplify your buying power. It's the use of borrowed capital, also known as debt, to increase the potential return of an investment. In simple terms, you're using someone else's money in hopes of making more money for yourself. Sounds great, right? But here's the catch. While leverage can certainly amplify your profits, it can also magnify your losses. Imagine this. You've invested £100 of your own money and borrowed another £400. If your investment grows by 10%, you've made not just £10, but 50. However, if your investment falls by the same percentage, you're not just losing £10, but 50. So you see, leverage is a bit like a double-edged sword. It can magnify your gains, but also your losses. So how does leverage play into short selling? Imagine you're at a poker table and you've been dealt a hand that you're confident is a losing one. Instead of throwing in your chips, you borrow some from your buddy, betting against the odds. That's how leverage works in short selling. You borrow shares from a broker, sell them, and hope to repurchase them at a lower price. The difference is your profit. But with leverage, you're borrowing more than just the shares. You're borrowing money to amplify your bet. If your prediction comes true and the price falls, you could reap substantial profits. But here's the catch. If the stock price increases, you're on the hook for that too. And with leverage, your losses can exceed your initial investment. Picture it as borrowing chips at the poker table, but if your hand loses, you owe more than the chips you borrowed. Short selling with leverage is not for the faint-hearted. It's a high-risk, high-reward strategy.